Hi, my name is Alisha, and I'm here with Salpi, and we want to welcome you to CapitalW Collective. We're here to explore the trends shaping the mortgage lending. Today, we're diving into non-QM, non-qualified mortgage, and why is non-QM becoming a major growth engine in today's market?
Yeah, I mean, with traditional volumes, we're shrinking, in 2024, 2025, non-QM was projected to get to like 70 billion for the year last year. And then that was up from 60%, I think, from the year before. So, one of the things we want to talk about is what should lenders be thinking about? How does this play out from a capital markets perspective? Just let's get into it and see what happens. Okay. So joining us today is Victoria Clement with 𝗧𝗿𝗴𝗴𝗲 and Jason Kopcak with Redwood Trust. And they've both been tracking non-QM trends closely. So, welcome, you guys. Glad to have you. Looking forward to get into it. And, let's start with the big picture in all this. So, as I mentioned, right, non-QM is booming. What's sort of driving this trend? Is there how should lenders position themselves to capture this opportunity? Victoria, what do you think?
But there's a lot of great drivers in the space. I mean, I think you mentioned, Salpi, that projections for this year, meaning last year, 2025, were much less than they actually ended up being. And the growth is continues to move up for a couple of reasons. Number one, there's more self-employed borrowers. Non-QM is sort of divided into two, maybe three general categories. One is bank statements, P&Ls, self-employed, anyone that has a percentage of their business self-employed, maybe possibly asset depreciation and asset utilization go into that too, as Jason knows. And then we've got DSCR, investment property loans, which have been really big and kind of on a tear this year. It's almost, in some cases, 50% of the market. So more people entering that space, more self-employed borrowers, more investors, even small-time investors, mom-and-pop investors, and just a market where, agency rates have been, refinanced, and that business has been, sort of stabilized. So it's been a nice niche for a lot of lenders. A lot of new lenders are entering the market to capture the volume. So we're still seeing, tremendous amounts of growth, which is great.
It is, yeah. So exciting. Jason, what do you think?
Yeah, no, I agree with Victoria. I mean, when you look at it, the self-employed market, it's been underserved. You look at self-employed and real estate investors, they've been underserved for a long time. So if you look at the agency's guidelines, it just doesn't, it's for more traditional borrowers, employed borrowers. So the non-QM market's been propelled by really servicing the underserved, the self-employed, the gig workers, the real estate investor. And as Victoria said, it's just a boom. The general view last year is, if you look at the large investors, the common number is around 125 billion in production, which is far exceeds what people expected. Because I think going into the year, we expected maybe 80 billion, 70 billion. But at the end of the day, that underserved market's really blossoming, and you're seeing these borrowers who traditionally now they can move up in housing. So instead of buying, for example, a $300,000-400,000 house, they can buy a $600,000-700,000 and get financing at a market level where the pricing makes sense. So it's been very fun to see that space grow.
And what do you think, Jason? I've seen predictions this year anywhere from 180 to 200.
Yeah, exactly. So the conversations I've had with a lot of investors, and I'm talking to some of the biggest investors, they expect it to be 150 to 200. And so it depends how it's a bit of amoeba. It depends how you cut the borrower base, but it's easily 150 to 200. And it's growing. And I think the beautiful adaptation now is you have some of the largest and mid-sized originators, even banks, looking at this product as a real product they have to offer. So they brought it in-house, and it's become a focus in their revenue stream. And so they bring specialized talent in-house to really service this underserved market, these borrowers. So it's exciting to see that shift from a niche market that, kind of was an outcast to now, a full-blown industry. So.
Well, so when you say bring in a specialized group, are you talking about like a specific loan officer type,
They're
or
bringing in capital markets, they're bringing underwriters, they're bringing even sales and credit people. So you got sales, you got credit, you have capital markets, and it's such a unique space, there's a lot of credit to it. There's a lot of nuances. It's a space of exceptions in a way. And so you have to have that specialized talent. And a lot of these shops are investing that capital. They're pouring real capital into that space. Yes, there's additional margin there, but you have to have the specialized knowledge to execute, both on the front and the back. And a lot of the mid to largest investors have completely invested in this space. So.
Yeah, and I think also the business originally started back, gosh, 11, 12 years, or maybe even more now, as a fallout product, right? What didn't meet the agencies? Non-qualified. That's where that word kind of came from, right? Didn't qualify for agency execution. And those that, it still remains in that category or approach it that way, they don't do a ton of business, but they do some. It's kind of getting their feet wet. Now it's a household product and a term and a process. And so, like Jason said, a lot of people are building framework in their organization around dedicated resources to these programs. Operations is big. I mean, a scenario desk that understands non-QM, that can filter and build a brain around these exceptions, because there is still a tremendous amount of exceptions in this business. I think it's about 25 to 30% of all the deals kind of come through that way, and then guidelines expand and contract from there. But I always encourage our customers to start to build that brain on your own, and then you can really embrace the product, and it's not just followed anymore, right? So
yeah, I think Victoria brought up a great point. When this market started back in like 13, 14, it was all about providing liquidity to borrowers who had really dented credit. They had issues coming out of the great financial crisis. They had delinquencies, could be foreclosure, bankruptcy. So the market was intended to service effectively the really old school subprime, and it never really took off. And so then the space really had to morph, and it morphed into the DSCR, and morphed into the self-employed bank statement. So you saw that transition. So today, to Victoria's point, the market's very little, like when you look at the true credit impairment, it's not a huge part of the business versus these underserved borrowers. So.
Yeah, that's true. So I'm still stuck on what you just said, 150 to 180 billion. Like, that's crazy. I mean, it's great, but wow. I mean, to jump from 70 billion, which was under forecasted apparently, when the dust settles, right, for 2025, now it's going to be 150. That's amazing. So you guys talked about self-employed, you talked about investors. Are there other niche segments that would want this loan?
Retires, asset utilization,
Okay.
Asset depletion, sometimes they call it, just different terms for a slightly similar product that have some overlap, but that's another way, using your reserves and income, retirement to qualify. Anything that's kind of a non-traditional W-2.
Oh, yeah, that's good. A lot of options. That's great. Yeah.
Well,
P&L as well, which is sort of a bank statement income, but it's really focused on the P&L that a tax preparer would do.
Yes.
It's kind of an offshoot of that. So,
And then I think when you get on the DSCR side, you'll see a little bit more asset-based lending. So, there's obviously, everybody knows there's income analysis, which we call it DSCR, but there's definitely a lot more asset-based lending getting done, which wasn't getting done before. That, again, it's effectively a relatively new product.
mm-hmm.
Yeah. Well, one of the things with growth comes risk. So, how should lenders be thinking about, balancing flexibility against, strong underwriting standards in this space?
Are you asking about like execution risk as well as underwriting risk? Because there are two.
Execution risk.
Well, there's a lot of different ways you can sell the product, which is nice, right? It's sort of like training wheels in some ways for some customers. There's a non-delegated platform, right? Which we have, that allows sellers to come to us. We do the whole pre-approval for them. Takes that risk, off the table from a credit standpoint, right? And then you can move into delegated, where you close the loans in your own name. But on as far as execution from there, there's flow, right? One loan at a time. Sell as you go. Take that risk off the table. Let the investors Jason and I and others in the space do the hedging for you, right? Provide the rate sheet on a daily basis, which you add your margin and send to, your loan officers or account executives to source loans from. And that's the safest way. It's the best way to get into the business. The other two options are a forward flow agreement, where once you've got something in your belt, you've got good credit standards, and you're sort of in this momentum going, you know what you're originating, you like what you're seeing, it's performing well, you can execute on a forward basis and just deliver as you go to a rate sheet. But it offers credit protection, as well, which is really, really nice. You always know that there's going to be a buyer for those type of loans. And then the third way is bulk, whether it's mini bulks that you accumulate and sell more often, or larger bulks you do once a month, but that requires the seller to do the hedging themselves. You want to probably tag on to that, Jason, about hedging maybe or something?
Yeah, so look, I think Victoria laid out perfectly. So when you look at it, there's definitely ways to leg in. I think it's very important to line up with who your investor is. Okay, whether it's wholesale, whether it's correspondent, but you want to line up and make sure you understand the guides, the process, the scope of diligence. I mean, because again, there's a lot of nuances, and you can get hurt by originating something, especially on the core side. You originate a loan where you're really not tied out on the soft guides, not just the hard guides, but the soft guides there's a massive variance in the soft guide side of the space. And so it's really important to tie out who your takeout partner is, understand their guides, their scope of diligence. So from you typically, if you're going to build it, you want to build it from the back to the front, meaning like you face the operations, your investor, get that scope lined up. You typically want to take one or two partners and really frame it in, and then you go forward and start doing your scenario desk and your origination side. So it's a space that there's a lot of upside, but there's also a lot of risk. And so, walk before you run. And I think, again, like Victoria laid out, brokering it, outsourcing the underwriting is an easy way to start, and then you can leg into it as you get comfortable with the execution. So,
yeah.
What about, oh, go ahead.
I was just going to add to that. So, NewFi has a wholesale channel, obviously. And so what we see is some of those clients start there, at least the retail clients, and they'll broker to add on to kind of the front end of what I just discussed and what Jason just mentioned. And you broker for a while, right? You get used to the buyers and what they want to see, and then you bring that in-house when you've got the support. So,
yeah. Now, from a credit execution, what about, like, I know we mentioned this kind of used to be viewed as more of a we call it non-agency, but back in the day it was considered the loans that maybe didn't perform as well because they didn't fit the credit box as the traditional. Any insight from either one of you of, like, in general, non-QM, how are they performing? Are you, as you mentioned, higher FICO scores than what you traditionally has been in the past, but any insight on delinquency or anything that would be concerning for a lender's perspective?
Victoria, you want to go? Okay,
I was going to ask you to go.
Yeah, so look, with any product or niche or vertical, there's always an expansion of credit. It goes through cycles. So when there's a lot of liquidity, there's not just on the investor side, but on the originator side, a lot of originators believe that if you create the product and somebody's going to buy it, there's liquidity, and it's not really the case. So what you have seen in non-QM overall, the performance has been good. Severities have been, very low, but there's definitely pockets of credit. There's pockets like P&L loans, higher LTV loans, DSCR loans below 1, where you're seeing a spike in delinquencies. Okay, and the reality is, it goes back to what we talked about. What's the scope? How's the underwriting? And what you're seeing, and I see this more so on the smaller lenders who try to get aggressive and they want to expand market share. They go after that space. There's more margin. They can charge more. They think that, hey, if I create a coupon that's a little higher, I can sell that loan. But those are the loans that are having less liquidity that the bond market and investors, when you look at investors, you got insurance and you got the bond investors. And look, we just got done doing a big road show last month, and every single meeting was those questions. What are you looking at P&L? What are you seeing? What's your high LTVs? And we're seeing it. So, for us, our product's been performing well, but again, we're restrictive. Like when we look at the P&L loans, we see the variance in guidelines. So you'll see these shops come in, and the market was up 30% last year, but some shops are up 100, 150% in production. And the way they get there is simply they expand out the soft guide. They get into these more edges of credit, and they take market share there, and then they load it up, and then they sell it, and then there's a correction, or liquidity dries up, and people get hurt. So, in general, non-QMs perform well, but there's been an expansion in credit, and you're seeing delinquencies tick up, meaningfully in these really what I call credit wings or edges of credit. So.
Yeah, and I think too, what's important when the sellers align themselves with investors in the space that are watching this stuff, like Redwood and Apollo, in our case, who owns NewFi. The thought leaders and the results of some of these delinquencies and these wing areas, as Jason, I like that word, calls it. It's important that we get that out to the community, right? And share that with our customers. And those are also the kind of investors that we encourage our sellers to align themselves with, whether it's us or others that aren't on the call. Because we all are in this to protect risk, right? We want the business to be good and solid, right? Bad eggs don't get very far in this space if we all communicate, right? And talk about it. And I'm not talking about customers necessarily, or brokers or appraisers, which there's all of that, but really more about the products. When we start to see something like this on the edges not performing well, we'll get it out to our sellers and have conversations about it, and encourage them to do the same, right? What are you guys seeing? You're on the front lines. We're not. We're correspondent lenders, right? So these loans are already closed by the time they get to us, and so we want to hear and talk about this kind of stuff. It's really, really important.
Yeah, I couldn't agree more. Like it's such an important part. Like when we see delinquencies or issues or fraud, bad appraisers or whatever, it's so important to pass along. I think we look at pre GFC, that wasn't done. Okay. People would shop, investors shop, and that shop appraisers, do all this. These days, like the moment, like again, we start seeing product come in and it doesn't fit our box, and we explain to people, not just we're not interested, but this is the issues around that product. Here's the delinquencies. Here's your fraud, here's what you got to look for. And I think it's so important to educate sellers, because at the end of the day, you want your seller base to stick around and grow. And if they originate in bad product and their scope of diligence is poor, they're going to get burned, and then you're sitting here trying to uncover these faults, so it's so critical to make sure you pass that information along, because it's just something that we're seeing a lot of it now. And I think the scope of diligence, the other part is, you'll see a variance in scope of diligence. Everybody does slightly different. They look for different things. So I think it's pretty important to tie out on your diligence, your fraud protection. What are you doing to what are your diligence protocols to uncover some of these variances that can be, that can create a default. So all that's critical.
Well, and that leads me to my next question is is there technology's changing. AI is kind of this big word right now. It's kind of like the Y2K is how I kind of look at AI, right? But, in this space, is there technology or ideas of technology that can make it easier or safer for lenders to consider?
You want to go first, Victoria? Or?
I wish I had them silver bullet on that one.
Yeah.
We have a big AI, quest and team. We're trying and using it to test in a lot of different areas in the space. But non-QM, unfortunately, I haven't seen yet, and I'd love to know if Jason has any silver bullets to help with
No,
that.
we have no silver bullets. I think if you look at non-QM, unlike agency, it's probably more on spreadsheets than ever. It's a very manual business. Like all of us, we're all looking at these different services. But if you really want to get, be honest, there's no magic bullet out there. There's no AI. We've all, I'm sure Apollo's got more money than us, but we've all put time into it, and we think it's going to be a big benefit, but it's not there today. So we're spending, a lot of our peers, we're spending a lot of time trying to build out APIs and data reconciliation and ways to really verify. And so there's no system I'm aware. It's building. It's building. It's in progression. I think the good thing is, a lot of us have been around a long time. We've seen the same, we've seen this evolvement and credit, and we've seen the cycle. And so we're all trying to solve for how do we cure these problems. Like Victoria said, it's important for us to have a good product, good process that's safe for the borrower, that's safe for the industry. So we're all, at least a lot of us are working towards creating that process, protocol, scope, credit guidelines. So this way, this industry can continue to grow and keep these cycles limited, to big,
Yeah.
Yeah, I think there's one little, maybe small area, although it's kind of important. You do get some lift out of it, is the bank statement review process.
Yeah.
There is technology that we use that even our sellers use it on their own, that can help do that analysis. And that's a heavy lift part of the underwriting process. It's the most time consuming, because, looking at a W-2 is a lot of your tax returns maybe could possibly be easier, not always, but bank statements can get onerous, right? So there is technology around that. There's a lot of good systems and processes in place, but it's garbage in, garbage out, right?
Yeah.
So you want to make sure that the input is accurate in every case. So we always ask for that backup.
Yeah.
Right? But we help our sellers do that. We do that for them. So.
Well, it's like Salpi said, for lenders who haven't stepped into this space, what comes top of mind? Like, what's the first step that they should think about to get started, to get into this non-QM space?
But there's so much. One for the very first step, I think, would be to think about who they want to align themselves with as takeouts, to have two, at least a minimum of two, right? And really dive into the guidelines and make sure they understand those, and can originate to them. Do they have loan officers or account executives that can source these types of loans, or teach them to source this type of loan? In some cases, that's what some firms do. And manage the risk all the way through the process, right? But it starts probably with the guidelines, the loan officer, in general, like any other product.
Probably the product development person, right, Victoria? Like, that person's got to be on board. As
right.
I have one, and if he's not ready,
yeah, there's the rollout. There's so much to it, but it's no different, I think, than any other new program that comes their way. But there is a mental understanding that needs to happen around the guidelines, and that's where you're going to get the support from the investors. Have them help you with that.
It's kind of like what I think you mentioned earlier, kind of, crawl before you walk, before you run. Maybe start the non-delegated versus jumping into delegated, or non-del versus del, things like that, just to start getting good at it. Right? Yeah.
Definitely. It's not difficult. It really isn't. And I think, we touched on this originally. This is not the old subprime non-QM blended, name for this product. It's not that way at all. This is a mainstream product. It's 7% of the market, and growing. So it's people are getting comfortable with it and doing more and more. And there's more and more borrowers that need to be served by this so-called niche, which isn't really a niche anymore, like you started off saying, right? So, that's the good news.
Definitely, there was a perception of it being that quote unquote subprime. And I would sit with clients, and they'd always be just shy about doing it. No, I don't know if I don't know, but now you're right. It's such a big part that it has to be embraced. I think probably from the top of the house, I would imagine, right? At the originator's office and product development, all that stuff. I think everyone has to be on board, but I think you're right. I think it's become so standard that you'd be missing out. It sounds like, if you're not jumping in. Jason, how about you? Any thoughts on that?
No, I think she covered it exactly right. I would advise people the same way, and I have advised people that way in the past. And look, it's like any other product in a sense. It's not hard, but you got to spend the time and commit yourself to the capital. But it's a great opportunity. Like anything, you got to commit yourself to it, spend the capital, put the infrastructure in place. And this, I love, again, like what Victoria said, there's baby steps. And the best way is lining up with somebody who you can broker out the underwriting, get comfortable that way, and then, just work your way up that way. That's just the easiest way to go. So.
Yeah, that's good. Well, from a capital markets standpoint, we talked about it already, everyone's on board, lenders are adding it to their product mix. We've talked about performance, right? You've already said it's performing well. The opportunities are there. Is there anything else from a capital markets standpoint that lenders should think about when it comes to non-QM, like liquidity, securitization?
Yeah, I mean,
Yeah.
I'll jump in here real quick. I think too many people, like the market gets robust, a lot of liquidity, so everybody wants to bulk up and sell bulk, and they jump in head first, and then there's a market correction, there's a pullback, and then all of a sudden they take a a financial loss because I think that it goes back to the baby steps, locking on flow. This locking on flow, the amount of incremental spread you capture by bulking up and selling is not what you think. Some people think you can bulk up and throw some odds and ends in there. Today, we underrate every loan. We look at everything, we catch it. Okay. So I think the value of flow is super important, and sometimes it's discounted because it's certainty of execution. It can be a little bit more labor because it's loan by loan, but in a product with a lot of niches and there's a little bit of volatility in the market, it's a great way to build your system and your program, until you get the size, and you have the sophistication, because, going to bulking, forget about securitization, bulking, is a different animal. You put hedging on and doing all that. So, you just got to be aware of it. You got to have the resources. And too many times we saw this past April when there's Liberation Day, there was a pullback. That's going to happen. That's not like a once in 10-year phenomenon. That's something that happens all the time. And so I think the being smart and focus on originations and lock in your profit early, just know what you execute, move it, and move on, is a much smarter business model. And yes, it's sexy to bulk up and sell bulk and tell people I just sold 50 or 100 million, or I'm going to do my own securitization. It's not easy. Okay, there's not a lot of originators doing their own securitizations. Selling bulk pools is great when the market's good, and when the market pulls back, it's painful. So I think that it goes back to the walk before you run. I think people need to really keep that in mind.
And also, non-QM is not easy to hedge.
Oh. Exactly.
That look on Jason's face was enough to agree.
Yeah.
There's no perfect hedge for.
There's no perfect hedge.
The hedge is to self-flow, but sellers do it, and we have many of them, and they do a pretty decent job of it until there's an event. So,
perfect example, you got Apollo. Apollo's very sophisticated, very large balance sheet. They have a lot of talent. Let them hedge. Let them manage that risk. You focus on origination. Like the originators, they have the origination process. They have the penetration. They have the marketing. That's another talent. That's an expense. Focus on that. Let the large shops, again, Apollo, let them manage the hedging, because it's not easy, and it's pretty complicated. It's an expensive. Those are expensive hires. So the value you catch by bulking up doing it yourself, it's questionable how much real true revenue you get off of it in the long term.
Yeah.
So,
well, what about somewhere between bulk, and I think Victoria may have mentioned it early, somewhere between bulk and flow, right? There's a possible forward option. Is that another thing someone should think about?
We do quite a few of them, actually. And it's if you want to protect your credit risk, but that comes after you know what you're doing, right? Months and months of origination, you start to have trends, right? And so you can say, here is our pipeline for the last 6 months. This is what it's probably going to look like for the next 6. I want to lock that down so I know I have a takeout for it. But I want to sell it on a flow basis. Right. And so it's like every 3 days you sell a little more. So there's maybe a 1 or 2 day hedge in there, and that's it that they have to do. And then they execute forward. But they've got guaranteed takeout on the credit side. So, and there's been, credit dysfunction in all of the markets, right? Not just in non-QM. Sometimes at the end of the year, people pull back and they're not buying as much, right? Not in all cases, but in some investors. So that is kind of a tweener, an in-between step, but it still requires the sophistication at the cap markets level, right? And so, you kind of, we have clients that bifurcate or trifurcate, I guess if that's the word, all 3 channels of execution, but most of them are flow. Even large bulk sellers that used to sell bulk years ago are flow now.
Yeah.
So from a cap markets perspective, right? And that's why you're asking the question about execution, safe bet.
Yeah.
You know,
Yeah.
just lock and go, focus on what you guys know, what the sellers know, originate good loans, work with your investors, get good feedback from them, have multiple takeouts, right?
Yep.
And then, you know, just keep moving forward.
Yeah.
And, you know, when you have a lot of experience under your belt and it seems to be, you know, more consistent, then you can think about the bulk side.
Yeah. Good. Yeah, definitely. That's great advice from both of you guys, because it is, people just want to jump to the sexy things, you know, but in this particular product, even though we're not going to call it niche anymore, it's still a product that's not easy to hedge. So, but along those lines, you know, again, just to recap, it's not a niche product anymore. It's a critical part of the lending landscape, right? So we just learned, take a first step, how to do it, get everybody on board at the company, start doing the loans, know your borrower, right? We learned all that, leveraging technology, managing the risk. We realized that the risk is pretty good, actually, not as bad in terms of delinquencies. Taking care of the capital markets piece is key. So I feel like we've addressed every angle of non-QM, but also I think from my seat, I'm hearing that this is becoming so big that we're going to need to have people start, you know, at the mortgage companies, right? Working, having different departments, you know, more opportunities for people, whether it's capital markets or on the sales side or on the ops side. I think there's going to be a lot of opportunities for people to come into this space and not be just so focused on just agency, you know, the market's being cyclical, right? We're a very cyclical industry. So this is great news in a way that it's so much production. So this, I don't know, from my standpoint, I love hearing this. This is so great. And can't wait for everybody else to hear it.
I think Salpi and Alisha, that we will know we have officially arrived when they stop calling it non-something.
Right.
Yes.
Non-qualified.
A new name.
Yeah,
We need
I
a
mean,
new name.
Non-prime.
yeah, girls,
What should
have
we
at
call
it.
it?
If you can think of something and change the whole industry in terms of the acumen, that
Right,
would be great.
right. How about specialty or specialty pro, specialty plus? We could call it all kinds of things.
Have at it.
So yes, but definitely this was great. Thank you. Appreciate you guys joining myself and Alisha. Again, thank you, Victoria, Jason. This was awesome. For those listening, if you want to learn more, visit CapitalWCollective.org for resources. So thank you for joining us. See you guys next time.
Appreciate the opportunity.
Yeah, thanks for the
Thank you.
opportunity.